Hey everybody, this is Jose Blasco. We are about to get started. Please go ahead and have a quick message on the chat box so this serves as a sound check. Apart from, it's always nice to say hi. And that way I know that you hear me well and we are ready to get started. So please go ahead and do that. A quick message, a quick hello. It's a great way to begin the session. Thank you so much, Ahmed. Mark, how are you, everyone? Good to see you. I will turn on the video stream so I can say hi here from my corner, as always. Good to see you, my friends. Very good. We got 30 seconds to go, so almost ready. Again, thanks for those confirmations. And we are about to get started. I'll take a sip of water so that way we are ready to go. Very good. Joe, how are you, Joe? Very good. Here we go. Top of the hour, isn't it? Welcome to the session, everybody. My name is Jose Blasco. This is Options with Options. This is October 27, 2021. Wednesday, the market is open. Let's trade options. That's the plan. Okay. Before we get started, I would like to highlight, as always, the disclaimer on the upper left side of the screen. So please read it carefully. This is important information. I'm counting on you to read it completely, to not to skip it. Again, it's relatively short, so I guess it's a reasonable request for you to read it completely, please. It is indeed important. Okay, very good agenda for today. We're going to look at the market. We're going to look at reviewing the trades that we have in the process. We'll look at trade management, what to do to those trades that are open. Typically on the Wednesdays, we spend most of the time there. And by the way, today I have a special question I need to answer. I'm not sure if Jeff is with us, but that's for you, Jeff. If you are with us or you're watching this recorded, we'll take care of your question, which is very important. It applies to Twitter, actually, which is a position we have open. And then finally, we'll talk about trade execution, which is, hopefully we can have available time to also find opportunities. Typically, we have more time for that on the Thursday, but indeed, in a perfect world, I'll make time for that today. Okay, so let's see what the market is going to provide for us today. Good. As we start, I always forget. So today I decided not to forget. I wanted to revisit a conversation that we had just a few times, which is using the link of your instructors. In this case, tradewithufos.com/Jose, could be /Becky, could be /Boyan, could be /Pedro, /Reynaldo, you name it. And when you use that link, the beauty is that you get to this page and then you have this help type of functionality where if you have questions, you can type them in here, title, description, insert image, you can attach pictures of the chart, the option chain, whatever is it that you need. And then on the below part, you have the answers, which, again, we started with this help page not too long ago, so the list is relatively short at the moment. But as this grows, you'll be able to look for, whatever is it that you are looking for. So you may come here and say, hey, I'm looking for auto climate stuff. So now you have a question about auto climate. So you are very likely going to find your answer very quickly with no need for you to wait for any email back, which, having said that, definitely ready and happy to answer your questions in an email. But if that's okay, I'd like to suggest to use that help page because I think it's going to make us more efficient at all levels. Okay. Having said that, this little reminder for everybody. So here is our top platform. Here is the chart of the S&P. I can see, Jeff, you're here. Wonderful. Good to have you with us. We're going to talk about, the Iron Condor and, the management of an Iron Condor question that you had, which is very, very important. And we're going to talk about this today. So let's do some market analysis first. Okay. So what do we have? It's almost copy-paste from what we had last week. Okay. And this is what happens when a market gets into an irrational type of behavior. Which again, irrational is a word that has a very specific meaning in the English dictionary. In this case, I don't mean the subjective meaning that irrational may have, in the sense that some people may believe something crazy is different than other people. In this case, what I mean is so probabilities were suggesting that a normal thing to happen for the S&P is to move up by 5 candles at a time, and it's been already moving by 9 candles at a time. Probability suggested that 0.99 extension was 2 standard deviations of the maximum extension before a change of climate, and we reached 1.5, which is almost 50% more than that. So again, I guess that you are with me now when I say that this is irrational. It's very, very strong. It's extremely strong. And again, fair enough. If we were to look at the weekly time frame, we know from the last week that we started a climate to the upside, supposed to last for 7 weeks. So it's the beginning, and because it's the beginning, it's probably the initial push, right? So you have an initial push, and then maybe a little bit of a rest, maybe another push, maybe a little bit of a rest, maybe another push, whatever. So we may be in that situation, and that's why it seems unstoppable at this moment in time. Having said that, we gotta take it easy, okay? Because statistics are there to be respected, because statistics will more often than not put us in the right side of the market. That's why there are stats. And my approach to trading today is exactly the same that I had last week. Last week we were entering that territory of being out of what statistics suggest. Today it's even more exaggerated. And what I was saying last week on Thursday was, I want to find a long, I want to find a short, right? And I want to find a non-directional too, which we said last week, and today it's difficult because the VIX is quite low. But I want to find longs and shorts both, because the market could continue and give another push, okay? Especially now that we are in that all-time high territory. But the market can also go ahead and retrace, and change climate, which is what would be expected, right? So we want to have a bet in both directions with positive gamma, so that way we offset each other, okay? And this, of course, also depends on what we have on the portfolios. From a UFO point of view, we have multiple UFOs relatively close to price. Those two UFOs above 454, 450 would actually be, above the black line, the EMA. The black line is 451, so 450 is just a bit under, but kind of, meaning that those UFOs may be hit in an up climate and react well. But again, if a down climate starts appearing here, a red dot, what tends to happen in a down climate is that the buy on field orders are canceled and more sell orders are added. So then those UFOs would lose power, and next thing you know, we may need to reach, 445, 443, 441 to get back into blue. Because remember, the moment we get red, statistics suggest it's going to last for a couple of candles, even though there have been times, as we know, that it's been longer. That is not happening often at all. That's why statistics suggest 2. So the normal thing to happen is this: 1, 2, 3. Okay, those 2 red climates, as you remember, I'm sure, unless you are new to the sessions, they were climates that were quite extended in the recent times, given the very impressive push to the downside that took place in those recent times. Okay, so with all of this said, there is one more thing I would like to comment on, which is also bringing neutrality, which is that the implied volatility for the calls is exactly the same as the implied volatility for the puts. So we cannot get a clear bias in any direction. And of course, the professionals, who are trading the options, they are doing the same analysis we're doing. So they are basically realizing that, betting strong in one direction or another is probably an error. So when we are looking at the options volume, notice that we got 1.0, 1.0, 1.3, 1.1. Okay, and it's very, very balanced. Okay, so it's that moment of indecision where, following that indecision, we may have a very strong push to the upside or a very strong push to the downside. So all of this coming back to my initial analysis, where I said, as a trader, I want to find longs, I want to find shorts, because really anything could happen at this moment in time. Really anything. Okay, probabilities at this time suggest it's going to fall, but being in an up climate on the weekly time frame, having just recently made an all-time high, we may have a very one of those extraordinary pushes, that could even continue the one we already had. Okay, so these things sometimes happen. Just like we had an unexpected, very lengthy down climate, we may have an unexpected, very lengthy up climate. Cool. Okay, so the VIX, I was saying that the VIX is quite low, to be specific, 16. Okay, so it's more or less about the same levels that we saw it last week when we were in the sessions together on the Wednesday and the Thursday. So then nothing too new there. It's about the same. And again, in this sense, you wanna hedge your bets because now betting too hard on direction, even if you find the best setup in the world on some specific stock. Remember, stocks are fragile. They depend on their industries. They depend on the S&P. So maybe the stock has a fantastic buy setup, but then the S&P falls, and guess what's going to happen to that stock? Typically, they would follow through. So it's important to always have that S&P as a guide to, more often than not, puts us on the right side of the market overall for our portfolio. Okay, good. Maka, how are you? Good to see you, Maka. Very nice. So, okay. So with all of this said, let's review our positions. Okay. So first, we have CL. Okay, CL, which is Colgate Palmolive. This is a trade that we plan on the 2-day time frame. Okay. So notice that this trade got to this speed bump, was supposed to bounce, didn't really bounce, then went sideways. Yeah, so far that trade is not doing too much for us, but at the same time we had an action. Okay, and by the way, this trade expires at the end of the week. Okay, on October 29 is the expiration date, and this particular trade is a trade where if I maximize it, notice how we have let me see. Yes, correct. So this is a trade where we had two bull puts, okay, that help us to buy this call, right? And then we added additional calls on top of that afterwards. So that's what we did. So in other words, we gave the opportunity by doing this tweak. What we did is basically it's put this trade in a position where if we were going to lose, it was going to be $133 maximum, which looks like this is what's going to happen. Okay, but we were giving this trade a chance to, if the trade was to rally ideally to 77, then this trade was going to be profitable, given the fact that the stock didn't do what we wanted it to do. So it was kind of like a damage control mode, giving the trade a second chance, and in the meantime limiting the risk. And then if something impressive was to happen, so now next thing you know, you can make more money. But this is absolutely very, very, very unlikely. Even reaching above our break-even point, which says 76.67. Okay, that's the break-even point. So 76.67. The current price of the stock is 75.93. Right. So we need a pretty interesting push. We still got 3 days during the week, so we could see that happen. But remember, statistics suggest that the S&P is more likely going to fall than rally. So I would say it's going to be pretty unlikely. So in any case, the end story for this trade, if everything works the way I just described, would be that this trade would lose 133, where the original risk of the trade was so much more, because basically it was the distance between strikes, which is $1 times 2, that's $200, minus a little bit of credit I believe we had, so it was almost $200, which we shaved down to 133. So hey, damage control mode. Okay, so that's what we have with CL, and really very, very little less to talk about because this trade is almost over. With Pfizer, okay, which belongs to the same sector, so we have similar scenario, even though in this case we can see a clear directional component. Okay, so this push to the upside, creating a UFO, it's indeed not a joke. What's the bad news? Well, the bad news is that this happened way below our entry price, which was more or less here. Okay, so we entered above the speed bump in this case, if I remember correctly. So in other words, well, yes, I do, because here's the vertical line that shows our entry day. So we entered above the speed bump and price went all the way below, I mean, like from 44 to like 41. Okay, that's $3 on a $40 stock. Do the math. That's a pretty impressive percentage drop against us. And right now it's coming back. Okay, we have until November 19 for this to work. So we still have, let's call it 3 weeks for this to continue moving higher. And in this case, this trade may have a little bit of a better chance than CL to end up in a happy place. In the meantime, we also acted on this trade, if you remember, when we looked at, again, these particular two bull put spreads that pay for a call, And because then the trade was not working well, we decided to reconvert the 49 call we had into a 47, 48, 49 butterfly. And when we did that, basically what we accomplished was to create a break-even point to be located at 42.93, which is just a little higher than where we are now. Okay, just a little higher than where we are now. So you would want to wait for the market to rally just a little more, and now you're gonna start seeing some green coming in. Even though ideally, it rallies up to 48, and then we would see a greater level of profitability. Okay, because basically we were in damage control mode in this case. So being above the break-even point, which is again 42.93, would basically pay $14, which is, when you think about the amount of contracts involved and the commissions paid. So basically it's just going to be, I don't know, $5 of profit. It's going to be nothing. But again, a trade that went against us very badly, we are giving this trade a chance to work for us. And worst case, the trade would lose 186, which is also a bit less than what we were going to lose if we did nothing. So this one is looking a bit better. Again, we have 2 weeks to go. So we'll keep discussing this trade and discussing the various possibilities. But that's how it looks at the moment. Okay. Jeff, do we close the CL on the last day or just leave it through expression? Yes, it's better that you leave it through, and let me give you a maybe not as well. So let me go back to CL and the risk graph. So the current price of CL is 76. Okay, 76. If we end up below 76, okay, the whole set of options will expire either worthless or auto assign or exercise. Sorry, auto exercise or assign, meaning that everything will go away. There will be no ownership, long or short of stock, as long as we are below 76. Okay, if we are above 77 and below 81, same story. Now the risky part then is to stay between 76 and 77, or to be between 81 and 77, or to be between 81 and 78. Okay, those would be the 3 risky places. And when I say risky, I mean because you have risk of assignment, which is not necessarily a risky thing, because then you can close the trade and that's it, or add options against, but then you will need to monitor that. Okay, again, this trade is looking like it's not going to work too well, so I would expect the whole thing to expire worthless, but you will need to monitor that on, as we are approaching the closing time on the Friday, to make sure that you don't get an undesired or an assignment that you are not aware of, and next thing you know, you left that position in your account for a few days, and that stock went against you 10%, and you didn't know you had those shares. So just make sure that you review those trades before the expiration. But in a perfect case, you just let it go and everything would expire, and that's it. Now, why did I say perfect? Well, because with most brokers, that would imply no charges on commissions. But with some brokers, specifically a broker that we use especially for futures trading very much, which is TradeStation, TradeStation charges $14.95 for assignments or exercises. So then in a case like that, it would be better to close the trade manually to avoid any exercise or assignment if you're going to be assigned, okay, or exercised. Because $14.95 in the world in which we live, where the commissions per contract, depending on your broker, maybe between 50 or 70 cents a contract, something like that. So now you pay $14.95 instead of, let's say, 60 cents. That's pretty intense. So just make sure that if you're using TradeStation, you are aware of that. And if not, as long as you are again below 76, or let me say it again, as long as you are not between 77 and 76, you are not between 81 and 77, and you are not between 78 and 77, as long as that's the case, then you're gonna be okay. Cool. Okay, so good question. Hey Joanne, good to see you. Fantastic that you're here with us. Very nice. What else do we have? KBH. Okay, so what is KBH? Well, this is a trade that it's a trouble. Okay, we entered this trade as a hedge for our longs, and not only it didn't work well as a hedge, it went against us big time. Okay, this was the entry time, this was the entry point. Okay, and notice how it went from 38 something to 40.77, which is the current price. Okay, so this trade, really worked against. Okay, now we were letting this trade an opportunity to work in our favor because the climate was quite extended. If you recall, we had an Elliott wave turning point that was not invalidated, it's still on the chart. But even though we had the Elliott wave turning point, it still went against the Elliott wave for a little longer. But now, yesterday, we got another Elliott wave turning point as an indication. And the climate, today, as you can see with the red dot, is being challenged. Okay, so again, this more than ever during all this time where it went against us, more than ever now looks like it's going to start moving in our favor. So because of that, I would say that we're not going to do too much to this, even though I want to give it a look, because it may be worth it to take our bear put spread. Okay, it may be worth it, made of buying the 39 put and selling the 33 put. It may be worth it, okay, to go ahead and convert that into a directional put butterfly. That would limit the profitability, but that would give the trade a chance to profit a bit better or lose a little less. Because if I maximize the screen, notice how the risk of the trade is $180, which is the debit paid. We paid 180, so what's the much you're going to lose? 180, okay? And if I bring my data window there, you can see that this blue line there, okay, it's 180 on the expiration date. Okay, so that's how much you could lose the maximum. So the question is, let's compare that spread. Okay, let's copy it, and now we have two versions of the same. And now the question is what if I go ahead and instead of selling one of the 33, I sell another one of the 33. Okay, I sell another one of the 33 at current price, midpoint, and then below 33 by the same amount. So 33 to 39 is 6. Okay, so that means that I'm going to drop this down to 27. There is no 27, so the lower I can get is 30. So let's try 30. So if I sell the 33 and I buy the 30, so let's see how much I'm going to get. I would expect it's not going to be worth it because it's also a very cheap stock, but let's try. So this is going to add 8 cents of credit to the trade, bringing the risk down to 172. And as you can see, as long as the stock falls, when we reach 33, you can still make that maximum profit. So the risk profile actually is great. The only problem is that the 33 put pays nothing at all, and therefore it's kind of not worth it to do it, especially because notice how the bid is 0, the ask is 10, same for the 30 put. So you may want to try to buy the 30 put, and you may not be able to buy it unless you want to pay 10 cents. And if you pay 10 cents and you sell the one above for 8, actually it's going to cost you 2. So because those strikes are very far out of the money, and because that stock is relatively low price, it's a $40 stock. It's not a $400 stock, it's $40. So then the amount of premium left in here, also because expiration date is only 3 weeks away from here, is November 19. So then the premium available is very limited. So that tweak, which could work very well with other stocks, in this case wouldn't work at all. Okay, so then we're gonna just leave it alone and let that trade to do its thing. Okay, now the one thing I will do though, okay, because the 33 put has a midpoint of 8 cents at the moment, okay, because the midpoint is 8 cents. So what I'm gonna do, okay, is I'm gonna place an order to see if I can buy it back at 5 cents. Why 5 cents? Because many brokers won't charge commissions if you buy back at 5 cents. And if I was to buy it back at 5 cents, so let me do this. Let me emulate, so you see where I'm going. So if I was to buy this at 5 cents, okay. So notice I sold the 33 put at 30 cents, and now I am buying the same 33 put at 5 cents. Okay. So this basically would leave me with a long put, okay, which is going to be classical risk profile of a long put. Now you can see the orange line, okay? The difference between the two lines is 5 cents, obviously. So now what could I do now if I got rid of the 33 put? What can I do? Okay. Well, what I could do now is I can do a butterfly. So I'm going to add 2 more legs. Okay. I'm going to do a directional butterfly. Okay. Where I'm going to sell 2 of the puts. Okay. But now instead of using that such a far strike, okay, I can do that very close to 39. Okay. So maybe I'm going to go for, let's say, 38. And then I'm going to buy the one below, which is 37. So basically, I'm rolling all of these higher, closer to price to get more premium. And if I do that, let's see what happens. Maybe it's worth it, maybe it's not. Let's see what happens. Okay. Yes. So that would be worth it because now my risk drops to $135. Actually, that's not correct because it's a butterfly. The risk also has to do with this difference between strikes. So actually the risk is 160, but there is a little bit of a drop from 180 to 160, and this could be an action that could make sense, especially if when you do it, the stock has been dropping a bit lower, you will get more premium, and this could actually make sense. Okay. Yeah, but at this moment in time, again, it doesn't. So what we're gonna do, okay, we're gonna plan for this for tomorrow, hopefully. Okay. So what I'm gonna do is I'm gonna leave this risk graph window. I'm just gonna minimize it. Okay, I'm just gonna minimize it and I'm gonna leave it there for tomorrow. So we'll revisit this tomorrow. But in the meantime, what I'm going to do with KBH, okay, which is here, is I'm gonna place an order to buy to close the 33 put at 5 cents. Okay, which at the moment the midpoint is 8. So I'm not likely going to get filled, but I just want a good till cancel order to buy this at 5 cents. So the moment this happens, I'll be able to then create my directional butterfly. So crossing fingers here, especially to be able to demonstrate this for you guys. Hopefully I get filled either between today or beginning of tomorrow. So then when we are back in the session live tomorrow, then I don't have this 33 put short any longer. I'm only long the 39 put, and then I can do that butterfly and see what happens then, okay? Depending on the premiums available at the time. Hopefully the market had felt a little bit, and then I can get more from that stock, okay? So confirm and send. So this is the one action for trade management that we have at the moment, which is to buy to close. Look at that, I just got filled. Amazing. Well, thank you very much. I'm not sure in a real account this would have happened because again, the midpoint was looking more like 8 cents. So you know what? I'm just gonna try to be a bit more realistic. So I'm gonna pretend this happened later in the day, and then I'll do the butterfly tomorrow, if that's okay. Okay. Unless you guys are doing it too, and you guys tell me that in your real accounts you are being filled, so then I'll do it now because if that position is freed up in your real account, so then we need to examine it immediately. Okay, but you got filled, Mark. Oh, wonderful. So I guess the market has just moved, and then it was not a little bit of a optimistic fill from the demo account of Thinkorswim. It was actually a real fill. Okay, great. So then, well, we don't need to wait until tomorrow then. So let's go ahead and go back to KBH. I'm gonna maximize this again, okay? And so let's see what we've got, okay? So I'm just going to go ahead and create another spread, whatever. I'm just gonna add a call, and that's not what I want to do. So I'm just gonna make this customized. So if I sell 2, okay, we are looking at puts using November 19. If I sell 2 of the 38 and buy 1 of the 37, okay, which is, what I did earlier in the orange part was now I'm going to sell 2 of the 38 and buy 1 of the 37. I'm just replicating this in an independent window with a magenta color so I can just analyze this by itself. So that is supposed to bring in up to 50 cents of credit. Okay, up to 50 cents of credit. Okay, this is what is likely going to bring in for us. Okay, so I just want to examine those midpoints. Okay, now the net result I want to analyze is the result here, okay? Which, wait a minute, okay, yeah. So I didn't look at this correctly because yes, I was focusing on diminishing the risk, and that we accomplished that. But notice how the whole orange graph is under the zero line. So if I do the butterfly with those strikes, then I'm not giving this trade the opportunity to make a profit, which means that 38 is too close to 39. So I need to try and see what happens if I do 37, 35. Okay, so I'm using 39 minus 2 is 37, minus 2 is 35. Okay, so I'm just moving everything down. And if I do, so now there is a little area of profitability, okay, and my risk is now 185. Okay, so it seems that given the amount, and here's the problem, okay, again, it's given the amount of premiums that are available, okay, I got very little there. It's almost the same as what I would get when I sell them. So then the premium coming in is not helping for this trade to be a brilliant one, okay? So we are gonna have to wait, okay? We're gonna have to wait until tomorrow. We just got rid of this option, which is good. Now, what we need to see is that we need to see the market fall. If the market falls, those puts will gain value, and then either the 38 or the 37 or any other combination may do the job of reducing the risk and still giving us an opportunity to profit. Okay, but at this moment in time, with the stock trading at 40.62, it is too far from that 39, and then it's a problem. Okay, now this is if we want to maintain the directional bias. Okay, take a look. If I do this butterfly this way, we get negative 12 delta. So that's a bearish type of trade. So we are maintaining the original directional bias that was minus 25. Of course, we cut it short because we are butterflying it. We are trying to limit the risk. So obviously we are going to cut short the delta, but it's still negative. Okay, so that's one choice. Another choice, okay, another choice that I'm going to have is copy primary spread. Sorry. Okay. Yes, I know what I'm doing wrong. Here we go. That's what I want to do. Okay. Yes. So now another choice I'm going to have is, again, let me do it one more time. Let me simulate. I just bought the 33 put at 5 cents, which we just did. 5 cents. Okay. Again, so this is what we have now. In fuchsia, we have a long put, okay, which is the graph of a long put in fuchsia color, right? This is exactly the same thing I did yesterday earlier, but then what I did is I added the butterfly version using 37.35, where both of those strikes are below the 39 put. Okay, both of those strikes are below the 39 put. What is another choice I have? Another choice I have is to go ahead and butterfly it, but butterfly it with strikes above. So if this is 39, I could sell 2 of the 40s and I could buy the 41. Now, you guys are guessing already what's going to happen to the deltas if I do that? So I am now making this trade to be non-directional. Okay, notice how if I was to do that, I'm butterflying it with strikes above my initial put. And now instead of a negative delta, I end up with a flat delta. Okay, now what's the issue? The issue is that, while, I am reducing the risk like I would have done before, the whole risk graph, the one which is fuchsia, it's below the zero line. So this trade would lose. So again, same story as before. We can look at using higher strikes. So what if I do 43 and then I do 41? So what would happen if I do that? Okay, I have the 39. I sell 2 of the 41, which is 2 strikes above. and then I buy one of the 43, which is two strikes above. So if we do that, what would happen to the risk graph? Okay, well, now we have a little bit of a profit zone above. Okay, we have a little bit of a profit zone above. Okay, but notice how the risk of the trade basically it's worsening. And in this case, we do have premiums, which are much more decent. But the problem now is that the difference between strikes is larger. Okay, so the only way we can try to fix this now, we have one last shot. Okay, one last shot. And again, it's always more difficult when the stock is low price. But here's the last shot we have. The last shot we have is to, instead of creating a balanced butterfly like the one I have, meaning that the strikes above and below are same distance, equal distance, right? So 39 is equal distance to 41 versus 43 is equal distance to 41, $2 each. So what I could do is create what is technically known as a broken wing or a broken wing butterfly, meaning that this butterfly now is going to have one of those legs to not to be equal distance, but be further out. Okay, and if we do that, so this is going to create more risk on one side and less risk on the other side. So now we're going to pick lots of direction. Okay, and so let's see what's going to happen if I do that. So what if I take 39, and what if I go ahead and sell 43, which is even higher, and then let's say I buy 45. Okay, so if I do 43, 45 is $2 difference on the upper part, but from 43 to 39 is $4 difference on the bottom part. So now that's a butterfly which is not balanced. And when I plot it, so you can see now how there is a greater size of a triangle above the zero line. Notice now how I made this trade to be bullish, right? Because the upper puts are nearer to the short puts. So I'm making this trade to be more bullish. Okay. Of course, what's the problem now? The problem is that my risk is so much more. Okay. So which is something that we don't want to do. So yeah, not working. I just wanted to show you the various alternatives because all of those things are very healthy exercises for you to go through by yourself when you are placing your trades and market goes against you or whatever. And you can evaluate all of those different scenarios and see the pros and the cons because every case will be different. Especially in this case, we're having an issue, which is the stock is not too expensive. And therefore we are not getting enough premium for those options. Okay. Then the other thing that's happening here is the fact that the stock went against us too much. It's too far away from 39. That's the problem. So therefore that option got nothing left, right? And because it got nothing left, so then it's a problem. So if the stock was to fall, then we may run the same exercise and we may have now a scenario where we accomplish that, giving the trade a second chance plus reducing the risk. Okay, so we'll re-explore that tomorrow, and therefore I'm going to minimize the risk graph so we keep it and we reassess this tomorrow. Could you please confirm that you guys were able to follow this explanation? Did I go too far? Was it confusing? Thank you, Mark Ahmed Maka, for confirming that you got filled. That's very nice. Which, by the way, that says a lot about the simulator built in the Think or Swim platform. To be honest, they do a pretty good job at trying to simulate the market. Anyway, so what else? Twitter. Okay, this is our last trade to review because we had a trade on FTAB last week, which I copied and pasted here, but we were not filled. So I'm just gonna delete that one. But Twitter, we were in this trade. This trade, it's about to conclude. And by the way, this trade had an added risk. Yes, I understand, Mark. I understand. I get you, my friend. So let's take a look at Twitter, okay, and let's talk about it because this trade, it's indeed in the challenging side at this moment in time. And the reason why it's challenging is because something strange happened in this trade that normally does not happen, which is the earning date changed to a nearer date. Normally, when earning days change, typically they are pushed backwards. Typically, when earnings days change is because I guess that company was not able to put all all the figures together to have the report completed. And therefore they push it back, a week, 3 days, whatever it is, and then they report earnings later. But with Twitter, not sure if it was a bad tick and the date that was reported was wrong, or some strange case, but they moved the date sooner. So next thing you know, now our expiration date, which is Friday, it's happening after the earnings has been reported, and earnings often create a shock. In this case, the shock is the stock is falling 8.78% today. Okay, so that's really not a good thing to see, because now, as you can see, we have our probability lines which are crossing our break-even line, which is that one here, and therefore it's time to act. Okay, now time to act probably is going to be close the trade. Why? Because the trade is currently making $39. So why would you take risk doing something with options that are going to pay you very little anyway, because we only got 2 days to expiration, 2 days and a half to expiration. So even if we do tweaks and conversions, we are not going to be able to do magic. So probably my conclusion today will be we just close it. That's it. But let's go over the process, and that way I can also answer Jeff's question when it comes to how do we manage the Iron Condor, what to do, when to do it, what's best, what's not best, because there are so many different things that you could do, and so many preferences and ideas and things. And again, remember, in trading options, everything got pros and cons. Okay, it's not like there is one way to do it which is always better, but certainly there are certain ways to do it which are normally more efficient than others, and this is what I'm about to share with you guys when it comes to the Twitter trade. Okay, so first of all, we put the trade together, okay, using those red lines, which at the time at which we put the trade together, those red lines which would mean the statistical range. Okay, this was where where we were going to see that stock trade within in a likely scenario. Okay, this is what those lines mean. So then we went ahead and we found UFOs, which set the bottom part of the range here. We found UFOs, which set the upper part of the range there. We run our spread select. We find Iron Condors that were providing break-even points that were beyond the red lines. So we accepted the trade, because we know that even if price goes below the red line or even the break-even line, because there are UFOs in that area, in the other time frames, right? In the 55-minute time frame, 89-minute time frame, there are UFOs. So what's likely to happen is that price is going to come back and be above the break-even lines on expiration. And therefore, it's all good for us to take the trade, even though the range is wider than the break-even line. So with all of this said, we have the trade in place, okay? And then, if I go back in time, so let me, or maybe I just can do it like this. So if I come back somewhere here, so notice how, the trade, okay, let me move forward. So for example, a bit closer to price, okay? So a bit closer to current date. So this is what they, 10/18, something like that, okay? Yeah, okay. So like 2 weeks ago. So notice that at this moment in time, everything is working according to plan. The red lines are within the purple lines, which represent break even, right? And therefore, you just let it go. And as long as whatever Twitter does, everything stays, all those probability lines remain within the break-even lines, then there is no management to be done. You just let the trade go. You just let time decay to take place, and that's it, okay? But in today's case, and to be honest, before that too, okay, sorry guys, I just clicked. I don't know where I clicked. Here we go. For example, in this particular date, okay, we had the line crossover. Okay, so here some action should have been taken. Okay, so I want to talk about what are the various actions that could have been taken, that should have been taken if you follow what I do myself. Okay, but indeed, right now it's happening too, where the probability lines are crossing our purple line, And therefore, this is basically telling you that based on statistics, we are likely going to see price to at least reach our break-even point or beyond. And that and beyond means now you start losing money. And that would happen before the expiration date, and that would be a sad end of the story because we've been profitable all the time, and in the last couple of days end up losing. That would be a big problem. And by the way, this is happening because that earnings report has been reported sooner, which is very strange, but it happened. So what to do, right? So what to do? Well, let me go back in time. So I explain the various actions to be taken, right? So, for example, as the stock was falling pretty hard at this moment in time, you can see that the red line in this case is crossing the purple line. So when that happens, okay, this is basically telling you you are at risk that on expiration that stock it's crossing that particular break-even line in the bottom part. So therefore, how can you offset the problem? Well, the way to offset the problem is to start doing what I call rolls and tweaks, right? So in this case, you would take the call side, okay, and maybe it's going to be better if I write on the screen, right? So the call side is you own a long call and you have a short call. So I'm just going to put that on the screen. So those trades were, somewhere here, okay, somewhere here. So what you would do is you would basically roll them down. Now, you cannot just do it randomly. Like, let's say maybe you were trading the 75, 74, and next thing you know, now you're going to roll them down to be 73, 72, just because you feel 73, 72 is good. No, you would do the same exercise. You would want to look for what's, just like when we draw that red line at the beginning, you will want to see what is the worst case scenario based on probabilities for the range, and then find UFOs. And let's say you have UFOs right there. So then you would roll the calls to that levels. So the initial calls were on the upper part. So then you bring them down. But by an amount that puts you beyond the probability line and, in a safe place protected by UFOs. Because what could happen when the market is moving very hard, and you can see it here, okay, for example, at the moment in time where it's dropping even harder. So next thing you know, you may have this tendency to roll the calls too soon or too close, because, when the market is falling like that, also think about the effect of human emotions. You may be like, oh my God, it's crashing down so bad. So let's roll down to protect the much I can. And next thing you know, so that market may bounce aggressively. I don't know how high it went. But, the market, or actually, if you did that, it would have been okay. But there are cases where, in that process of going up, it may go higher still without reaching what the statistical range was, but it may go higher above your calls. So now what's happening now is that your calls on the upper part are creating a problem. Instead of helping the risk on the bottom part, they're actually adding risk on the upper part in case there is a rebound. So you always need to manage how close you roll and not to be greedy with the amount of premium to be collected from that roll to protect the other side, okay? So anyway, so if I go back in time, click in the right place, here we go. So if I go back in time, we were here. So on that particular day, you would have done a roll, and let's say those calls were brought down here. The moment you do that, this would have generated a new break-even point on the upper side and a new break-even point on the bottom side. So the bottom side break-even point will be lower, and the upper part break-even point would also be lower. It's kind of like you are shifting the range in both sides. Okay, so as you are doing that, okay, now the trade keeps progressing, and now you have another cross. So what will you do? Same story. You would reevaluate the new location of that thing. You will reevaluate and check that you got UFOs. Okay, and the moment you got that, then you would do the same action, because the side that is still at risk is the bottom part. So you would do the same thing. You will roll those calls a bit lower, which by doing so, it will bring the upper break-even a bit lower, and it will bring the bottom break-even a bit lower as well. Okay, And then what? You go to the next day, and the next day in that scenario, so you are not crossing over, so you would do nothing. Not crossing over, you do nothing. And the next day, huge push to the downside again, crossing over again. So same story one more time. You would be looking at the statistical range. You would be looking at UFOs to be above in the 55-minute time frame, 89-minute time frame, etc. And again, this may give you another opportunity to roll down. Maybe yes, maybe not, because you may have those UFOs, you may not have those UFOs. So the chart will tell you, I'm just pretending every time you had to roll, you had an opportunity to roll. And this again, we do the same thing. It will bring your break-even above a bit lower. It will bring your break-even below a bit lower. So again, you keep shifting the range, trying to readapt. So what will happen now? So now you're not crossing over on the next day, not crossing over on the next day, crossing over on the next day, but now you're crossing over on the upper side. Okay. So now the risk is on the upper side. So then what would you do? What you would do is the same on the bottom part. So you would look at the bottom part. You would look at the statistical range, right? You would find UFOs below, and remember the bottom part is made of selling puts and buying puts below, right? So this is something that currently in the trade would be, let's say, somewhere here. So the moment you had identified the new statistical range here, the moment you have identified, let's say, some UFOs on the 55-minute time frame there, so you would be able to take those puts and roll them higher. Okay, and what would that do to the break-even points? Okay, well, I should have changed the color of the break-even points. Let me make this, I'm gonna make it black. Okay, so the new break-even point below, okay, would be now raised a little higher, isn't it? It will be a little higher, and same with the break-even point above, which I'm gonna make it black again. I should have done that before. Okay, so this break-even point above would also be moved a bit higher, right? And again, you are now again moving the range one more time. Every time you are doing those rolls, I haven't said it, maybe I should have. Every time you do those rolls, you are closing on a small profit on either the call side or the put side, and selling options with more premium. So collecting more premium to defend yourself, while you keep the same risk, but because you already collected premiums in the form of profit and you add more premium, you are actually diminishing the risk. So you diminish the dollar risk, but you make your range to become narrower. So the probability of piercing the range is more, but if you get in trouble, the quantity of loss is less. So you are balancing out the situation, because while the probability of piercing the range is more because the range is becoming narrower, you're also getting closer to expiration, and therefore you have less days to pierce the range. So you are kind of balancing everything out by doing those actions. You guys, please go ahead and tell me if you are following so far. Okay, so those are the actions. Just tweak above, tweak below, depending if the range is being pierced below by the probability line or the range is being pierced above by the probability line. The probability line is, again, the lines that we get from the probability cone. Okay? So now what happens? The next day, nothing is piercing. The next day, nothing is piercing. 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 So you just let it go. Let it go. And now it's piercing on the upper side. Okay, on that day, it's piercing on the upper side. So what will you do? Same story. You will now look at the statistical range on the put side, find UFOs on the lower time frame, 55 minutes, 89 minutes, etc. Okay? Got you, Mark. And then what would you do? You would take those puts and roll them higher, assuming that you got the UFOs and you got everything you need. So roll them higher, and this would, again, one more time, bring the break-even a bit higher on the bottom part and the break-even a bit higher on the upper part, even though you would now see less changes on the break-even locations, because as you are approaching expiration, so the amount of premium you will collect is going to be more because the units are closer to price, but less because time to expiration decays the options. So then the variations on the size of the range is going to be less and less. But it would be something like that. It's kind of, the range is kind of readapting a little bit. And now, not piercing, not piercing, not piercing, not piercing, not piercing, not piercing, and now it's piercing. Well, actually, if the black line was the one we have. It's actually not. Okay. But again, because we didn't do any roll, okay, in my case, in the positions we have in the account, I didn't do any roll. So then it is indeed piercing the line right now. Okay. So, so what do you do? Well, you do the same. So let's do it. Okay. What do? You do the same. Let's evaluate our situation. Okay, which, as I said before, probably the end conclusion in this case will be just to close the trade, especially because this is a weird example where earnings were pushed forward in time, and therefore, basically you lost your edge, right? And because we're in profit, so probably just get out and that's it. It's probably a good choice, but let's pretend it's not the case and let's evaluate the situation because maybe we have a better exit. Thank you so much, Jeff. Thank you so much. So, so what are we going to do? Well, we're going to look at the worst case situation, and I'm going to zoom this in, okay, so we see it better. So because we are piercing the bottom part right there, so we're going to look at the worst case situation, which is right here. Notice the worst case situation is not red line anymore, it's the blue line. Why? Because that stock reported earnings and implied volatility dropped. And therefore now there is more historical volatility than implied volatility, okay? Which is the other reason why probably doing the tweak, doing the roll is not going to help because there is not so much premium anymore. But in any case, we're just going to go with the rules and see in the end what happens. So I would now look at what is the statistical range, which is from here to here. Okay. And I know the calls I have above, which in the case of Twitter are the 75 and 80 call. Okay. Those are the calls I have. Okay. So I got 75 and 80 call. Those are the calls I have. Okay. So hopefully I can roll them down. Okay. So let's take a look if I can roll them down or not. And for me to know that, I'm going to have to find in the 55-minute time frame, I'm going to have to find UFOs above that should be illegal. I agree with you, Marka. This is catching people, basically off guard, completely off guard, isn't it? So, okay, so on the 55-minute time frame, we are looking for red UFOs above this tiny red line, okay? And notice that on the 55-minute time frame, we don't have any. What about the 89? Okay, it's taking a little bit of time to load. We'll let it do its thing. By the way, remember the rule is 2 UFOs above, right? So we need to find 2 red UFOs above that red line. And here it seems that we may have that. But probability is 47.84. My minimum is 48%. It's almost there, but it's not. So I'm going to move to 144. So with the 144, we got 55%, and we got UFOs right here. So my tiny red line is right here. This is UFO number 1. This is UFO number 2. So we are talking about 68. That's what we're talking about. 68 or above. Okay, 68 or above. So let me come in here. And again, take a look at the break-even points. It's 76 and 53, right? This is what we have now. So let me compare spreads. Let me copy the primary. Okay, let me edit the spread. And now I'm going to emulate. I close the call side. How can I emulate? I close the 80 and the 75 call. How can I emulate that? Same I did before. So I'm going to add 2. So I'm going to buy back the 75. And I'm going to sell the 80. Okay. Again, this is something that you'll get used to it as you use the platform and you trade options. This is, piece of cake. But it's indeed confusing because I have so many rows there. So make sure you are focused, okay? Don't do this while you're texting on the phone and things like that, okay? Because then you get in trouble in the market, and then you need to rectify the trade, and it's all about paying commissions, getting slippage. So make sure you are focused, okay? So remember, we are selling the 75 call. We sold. So now that same call, I'm buying it. Okay, it's the same 75, I'm buying it. Okay, and vice versa with the 80 call, which we bought. So now I'm selling it, and that's the 80 call. Okay, if I do that, this emulates closing the call side. Okay, so if I close it like that, notice that now the risk profile is like the risk profile of a bull put, which is the only thing I got left in the account, a bull put. Okay, so now what do I want to do? Well, we said I'm gonna sell 2 more calls, so I'm gonna add 2 more, 1 and 2. One is gonna be sell, one is gonna be buy. Okay. Let me go back because I forgot the values. So we said 68. Okay, here we go. 68. 68 is the number. So we want to sell 68. Okay, so the one we sell is 68. Okay, 68. And the one we're gonna buy, we were using $5 strike price increments. Okay, so just to keep it the same, to keep it balanced, we're gonna go for 63. Hopefully the strike exists. It does. So we're gonna do 68, 63. Okay, and let's see how much this brings in. Okay, not too much, and that's why I told you that, you know, we are likely going to leave it alone. Oh, wait a minute, did I make a mistake there? That risk profile makes no sense. Give me a second, guys. I must have made a mistake there. October 29. Oh, I should not sell the 63. I should sell 5 strikes above. Talking about not making mistakes. So 68 and 5 is 73. Here we go. Now I'm going to have an iron condor type of risk profile. Yes, correct. Now I have it. Okay. Now, what's the issue? The issue is that the 68 call and the 73 call, they are not too close to price. There is only 2 days and a half to expiration. Earnings already went by. So the shrinkage of premium, as you can see, the red line was within the blue lines. So basically it's giving you 2 cents. So in other words, if you compare the risk of one trade versus another one, it's basically you can see the lines there, right? It's the same. The only difference is 2 cents, $2. So this is not going to be worth it, and that's why I told you that probably we were just going to close the trade and forget about it, because it's an anomaly with that earning dates being reported ahead of time. Okay, it's a great, to be honest, it's a great example for the purpose of these sessions, because you get to see this and you are not alone. So it's not like, have I done something wrong? No, you haven't. It's just that this happened, which is very strange. But in any case, I mean, you can see the process. Okay, and let's say that was a different case. So I'm just gonna make up a few values so you understand how it would look like. So let's say you were able to collect 80 cents for the option you sell, and let's say you were to pay 55 cents for the option you buy, right? So if you were to collect that instead of 4 cents and 2 cents, okay, meaning that you are further away from expiration, the calls are closer to price. So then you click OK, and now notice how the risk now has been diminished. Okay, the risk now has been diminished. So notice that the maximum risk, instead of $390, becomes $365. And again, if you had done that multiple times, as you saw on the chart, that this was done since the trade started, this should have been done 4 or 5 times. So every time you are shaving risk, shaving risk, shaving risk, and now the net result of the trade will be much better. But at least you get to see the effect if you do it once, okay? Even though I had to make up those values for you to see, because there is no premium left, okay? So we are not gonna do it, okay? We are not gonna do it, but this is what you would do, okay? Now, let's go, I'm not gonna close this, okay? Let me move it away, and I'm coming back to this window in a moment. I know it's time to complete the session, but I want to complete this explanation. So let me go back to the daily time frame, okay? And let's pretend that what's happening now, okay? So let's pretend that what's happening now, it's worse. I mean, the stock already dropped 9.3%. Let's say it's worse. The stock is dropping like, 10 point something percent, and you are actually crossing that line. Okay, you are actually crossing that line. But if you are crossing that line, it's not time to do rolls. It's time to do a full conversion. Okay, and what you would do then is you would convert the iron condor into an iron butterfly. So the iron condor was made of using 8075. So let me write it down. So you got the 80 call, 75 call, and then we got the 55 call, 55 put, and 50 put. I believe that's what we have. 55 and 50, 80 and 75. Yes. So that's what we have. Okay. So this is what we have currently. 80 and 75 above, 55 and 50 below. Okay. And let's say you have done a tweak. Okay, and the tweak brought you down for 73 and 68. So then instead of that, copy. So instead of that, paste, you got 73 and 68 on the upper side, okay, which, would be where you're at, okay? So let's say you are here, and now this thing keeps dropping and crosses, not our probability line, but the price of the underlying, okay, the candlestick is now crossing your break-even below, okay? So what will happen? Okay, well, by the way, I didn't show you something about the break-even. So notice what happened to break-even. Yeah, in this case, it's a little bit of a made-up case with my made-up values. So now, notice how 76 becomes 68, and notice how 53.90 becomes 54.13. Actually, this should be a bit lower. But again, because of those made-up values, so probably, these values are not representing the reality, and the break-even is distorted. But my point is, the range keeps moving with your tweaks, okay, as I was saying before. So now, price is now slapping us on the face and crossing the break-even line. And now we're going to start losing money. So what can you do? Well, the last shot, okay, the damage control, the ultimate shot for damage control is done converting the iron condor into an iron butterfly. How is that accomplished? Well, this is now accomplished by doing another roll, okay? But now the roll is so aggressive that basically you were selling the 55 put, so you're going to be selling the 55 call, the same one. And then because you're using $5 strike price increments, then you're going to buy a call $5 above. Okay. So in other words, maybe a better way to write this would be like that. Okay. That may be more visual for you to understand what just happened, right? So you had the 55.50, and now the calls, you roll them down all the way to where the short strikes align. So you are technically converting that into an iron butterfly. Let's do it so you see what happens. If I do midpoint, and I do sell the 55 and buy the 60, okay? So this is now creating this particular risk profile where notice, okay, let me maximize this. This is important for you to understand. Notice that now you are basically giving up on a lot of profitability on the upper part of the range because your break even now is here, okay, which is 57, okay, which is way lower than 76. Okay, so you are betting on that stock to remain low, okay, but you are also giving yourself a chance for the bottom break-even to be further away than the original break-even. The original break-even was 53, and now you could allow that stock to drop by another $1 and you're still in profit. Okay. Now the other benefit is that now your risk that was initially 390, now it becomes 292. Right? And if you have been doing rolls and tweaks during the life of the trade, it would be even less. And then the log factor, Okay, and I did use the word log because this is what it is at this stage, because you were wrong on the trade if you do this. So now you are exposed to fortune, if you wish. So let's see what's going to happen now, because I was wrong. So that's it. So then the log factor now comes by, if you are lucky enough to have this trade expire very close to 55, you can actually make more than what the original trade would have made, which was 100 plus. Now you can make close to 250. Okay, so that's the log factor. But basically what you're doing is you are displacing your profit zone to a lower end, and that's giving that trade a second chance to survive, in case nothing works. Okay, so now 5707, okay, is more or less here. Let me draw it here. So 5707 is more or less here. To 5292 is more or less here. Okay, so basically now your profit zone sorry guys, give me 1 second. Sorry for that, guys. So your profit zone now is, as you can see, the blue area here, meaning that all that area will be profitable before. Now you would be in a loss if you end up above 57 plus, but now in that area you get the benefit of having that extra room of profitability below the original break-even line. While if you end up exactly at 55, which is the midpoint of that area, actually you make more than double than what you would make. So it's a great way to try to gain some control against a trade that went totally rogue. And there is a luck factor in there because of course your plan didn't work according to plan in this case, because earnings days change. So yeah, so that's why in this case we're not gonna do that, because we haven't crossed that line yet. So we are not in trouble. Actually, the trade is showing a profit at this moment in time, not too much, but it's showing a profit. So this trade is currently profiting by $39. This is the real-time P&L of the trade. So I would like to close it, collect that money, and run, because it's good enough to be able to exit a trade that didn't behave as expected, where a major change of plan took place in the middle of the trade. Is great enough to be able to exit this trade for a profit, instead of now needing luck on top of luck to end up okay, or hoping all is going to be good, right? So you don't want to hope this trade is not following your plan because of an earnings date change. Get out. That's it. So I'm going to try to get out at 81 is the midpoint. Let's see if I get filled. So I'm buying back the condor, and if I don't get filled, I'll try to change. I just got filled at 72 actually, with great price. So okay, thank you very much. We're out of the trade. We made a profit here on Twitter, and the trade is over, and now we have work to do tomorrow to put new trades in the account. Joe, why not to close the put side? Because here's what's happening to the call side. And I get your point, and you're looking for efficiency. You are looking to save a couple of commissions, but guess what? You're not gonna pay those commissions anyway. I mean, it depends on your broker, but in most cases you wouldn't. And here's why. So if you close the 75, which you're short, and you sell the 80 that you're long, okay, so notice how much you're gonna get for each, right? So now let's say you close the put and you leave the calls in. Well, the net result is that you're gonna save yourself commissions if you use a broker that charges you commissions, like Thinkorswim, for example, doesn't charge a commission if it's 5 cents or less. And on top of that, now the most you would make is $2 if you're right. But what could happen, especially when a stock moves very fast in one direction, you may have a massive move in the opposite direction, and it's going to be rare because technically speaking, those options got zero delta. So the pricing model tells you it's almost a sure thing those options will expire worthless. But believe me, I've seen it. The next thing you know, the stock goes crazy. And next thing you know, now you got a $500 loss there. Okay, just because you were trying to make $2. So my suggestion, just get rid of it. So then you don't need to watch it, you don't need to worry. Just focus on new trades that are more quality, and that's it. That would be my suggestion. Now, of course, if you're a trader who you prefer to watch it, you happen to be a trader who spends decent amount of time in front of your screen, you're watching there before the close of the day, all of those things, then yes, it's not wrong. Your approach makes sense, Joe. But again, in my mind, putting yourself at risk of $500 just to make $2 more, it's recipe for trouble. Believe me, there is one day you're gonna get hurt. It's gonna happen. I've seen it happen. So you see those options that they are like 3 cents, and then the option becomes $5 in 2 days, and it's like, what just happened? Well, what happened is that the stock exploded. The stock moved up 10%. Next thing you know, now you're in trouble. So it's not likely to happen, but it happens, and it's gonna catch you one day or another. It may take 3 years, but it's gonna happen. And that day, then you may decide, look, I've been making $2, $2, $2, $2, $2, $2 extra for 3 years, and now I just lost 500. It was not worth it. Okay, so that's kind of like the experience I'm sharing with you, even though there is a component of personal preference in your decision. And what you said is not wrong, Joe. Okay, so just keep that in mind. Yes, Jeff. And the last week is the iron butterfly. So then we just let it go to expiration. And then on expiration, you either got a profit or you got a loss. And that's it. You cannot do much more about that anymore. Keep in mind that an iron butterfly is likely going to, it's more likely going to get you some sort of an assignment. So you do need to watch that iron butterfly into expiration Friday. So you know what to do if you're about to be assigned, to either close it before that happens, or get long or short shares against, or get a protective call that expired next week. Again, we talked about this in prior sessions of what to do if an option is about to get you assigned and you want to avoid or mitigate the risk. But yeah, you would just let it be until it expires. Cool. Well, Jeff, that was a very good question in your email, and I guess you are with me that you understand now why I could not explain that in an email. And hopefully this is a session that you guys may go back and rewatch, because of course it's many steps, many tweaks. It's the same thing really if you think about it, but it could be on the call side, it could be on the put side, or the ultimate step, which is when you then go for iron butterfly, which is the last step. The key is to respect those UFOs, respect those probability cones and probability lines, so you don't get greedy by rolling too close to price and then it bounces against you, and you thought you were going to help, and then you're actually creating trouble for your trade. So just make sure you just follow the rules, and sometimes you may have the probability cone crossover, and it's time to do a roll, but you cannot do it because you don't have the UFOs, for example. Right? So then you don't do it. You just wait until the next day. And if the next day something happens, you try again. And if it doesn't happen, you try again the next day. And if it doesn't happen at all, and now the underlying is crossing over, then you butterfly it. Okay, which is the last step. Okay, but you cannot roll too close to price just because, if you don't have the proper protection from the probability cone and the UFOs, because then it will slap you on the face. It will rebound, get you in a problem. You will then roll the opposite side. Then it will bounce in the opposite direction. And then you are being hurt on the call side and you are being hurt on the put side just because you move the units too close to price without those UFOs. So, yeah, anyway, we'll call it a day. Hopefully this was useful, my friends. Tomorrow we have trades to do, okay? So be ready for that. And keep up the good work. Yeah, reducing the risk, guys, it's a major component of success in trading. Again, it doesn't help every 3 trades, but it does help after a month, after a year of trading. You look at the differences in your results if you had done it versus you have not done it, and it's a very big difference. It could actually get you to profitable versus not being profitable. And if you were profitable no matter what, it could get you to be way more profitable. So it's indeed something to keep in mind. Okay, cool. See you tomorrow, my friends. Pleasure, as always, meeting you here, and thank you for joining me, my friends. Bye-bye. See you then.